Alright, it is today Monday the 6th of January 2025. This is a price action review. I'm going to go over the NQ today with the contract month NQH 2025. I'm going to specifically dive into the NWOG opening gaps since they were a very significant factor in today's price action. The event horizon PD array, and I will go over a London session trade. Alright, starting off at the daily chart, you can see that overflow has been longer term extremely bullish. So whenever that is the case, we do not look to try to pick it up, meaning that every decline lower is immediately anticipated to be a retracement to set up a new opportunity for short money to go long in a discount. So we don't look for when this significant decline happened that price will revert and just continue to go lower, even though we do have these very smooth vertical lows, basically like a trendline phantom. We would not look for that because of the extreme bullish order flow. So basically what I then do is just look to define premium discount and look for discount arrays either on the daily chart, a weekly chart, or the monthly chart. In this case we had a very obvious volume imbalance on the weekly chart, which we traded down into on the previous week. Then we showed a rejection of it, initially at least, trading back into the daily CB here, specifically this bearish order block, which converges with the upper quadrant of this CB. Then we trade lower again, back into the volume imbalance on the weekly chart. Notice how it is indeed in a discount. I would define it by this dealing range high, because it took out liquidity and it's the all-time high. There's no higher point in this. And then a low that took out sell-side liquidity. Now we do have these vertical lows like I stated, but I would pick out this low because it took out this low, so it took out sell-side liquidity, and then showed a very significant displacement higher, so a lot of energy behind this move. So I would define this as the dealing range low. So what if it would have broken down? Then I would just go lower and look for the same idea, a low that took out another low, and define that as the new larger dealing range. So basically what happened here is that price took out a previous week low inside of the weekly volume imbalance. Notice how the bodies are respecting that even on the daily chart, staying above the midpoint of it. Exactly what we want to see when we are looking for reasons to justify higher prices. And then we look for a SMT at a key level. Why is it a key level? Because it resides in discount. So this was like a very clear signature, this SMT, when I was already expecting higher prices, that really supported my idea of looking for higher prices. So in my weekly forecast I outlined this previous week high as the next near-term drawn liquidity. Well, first of course this daily CB, this small fair value gap here, which is basically just inside of this larger one. And if you really look closely, it's actually a balanced price range, which we reached up into today with Monday's trading. But then the next round liquidity beyond this would be the previous week high for me. I am a little bit more held back in my analysis because it's January, it's just really the start of the new year. So what you tend to see at the start of each year in January, that price action is a little bit more fickle, more consolidating, and when we look to intraday price action, it's much more prone to higher resistance, liquidity room conditions. So what I generally do is just wait the first 2 weeks and just observe price action, do some studies, and then around the 14th, 15th of January, then I can potentially resume trading if the conditions are favorable. But the daily bias and weekly bias has been bullish, So that is what I went into in my tape reading and demo practices today. Alright, let's quickly do this. Alright, 4-hour chart. You can see, if you are even a little bit familiar with the concepts, we have a market maker buy model here. Original consolidation defined by this all-time high, low resistance liquidity and signatures, continuing all the way to here, so it's very clean here, which is what we look for. We look in a market maker buy model for a low resistance liquidity run signatures on the sell side of the curve, which is basically just the drop down prior to the reversal. So you can see here that turn on the data chart really much more defined on the 4-hour. Notice how price then really just show displacement higher. You get a change in the state delivery here, and then even a market structure shift here. Then price came back down into this inversion order block or inverse order block, and then showed a continuation higher up into this balanced price range. So why did I define this as a inverse order block and not like a breaker? Now, because we have a low, high, lower low, but this is like a higher high than this one. So if it's not clear, I wouldn't define it as a breaker. And I didn't define it as a mitigation block because it's not that clean as a mitigation block either. So I would then just see it how it is, which is it was an order block here on the sell side of the curve, provided resistance to send price lower. Then when it came back up into it, trade above it, I would just use this as an inversion level and define it as such. You could have just defined it as a mitigation block, like the essence of the delivery didn't really differ, like what it could have done for a mitigation block, but I would just define the differences between a mitigation block and inverse order block like this, just for consistency. Let's see what we have more on this chart. Yeah, we have a better price range. Why? Because we offered buy side delivery here, then sell side delivery, then try to gain back up into it, failing, and then displacing lower, so it is now efficiently delivered buy side and sell side. If you would look for lower prices and you were bearish, then you would look for this level to provide a measure of resistance as a premium array and send price lower. However, I don't expect the market to go lower from here. So I will specifically look when I anticipate opposing premium arrays to fail and I am bullish. I look for price to rapidly trade up into it. So in case of this balanced price range, I would look for price to rapidly trade up into the balanced price range and then violate the midpoint of it. In this case, we hadn't seen that yet, which may happen tomorrow, may not. I could be wrong, of course, especially in January. You can be more prone in general to be inaccurate due to it's just getting going. Like 3 has to get going. The markets, it's not as clean in other months. So, but it's still a very good practice to just tape read and observe price action, just get a feel for it after the holidays, and that's what I do. So 1-hour chart, we can see a smaller 1-hour market maker buy model fractal. You can see here the previous week high is on the 1-hour defined as the original consolidation. So it's really just indeed a smaller fractal of what we saw on the 4-hour, which is just really, it remains fascinating to see how the nature of price is fractal. It's just so beautiful to see how everything on every time frame is the same, just on a different scale. Which means you can basically find, if you understand how to read price on any time frame, you can find setups. So you can utilize any discipline if you want to. I personally specialize in like scalping and intraday trading because it suits my personality best, but over time I would like to graduate to more a universal approach and be able to do precision trades too, or swing trades, etc. Like that you can have put your eggs in multiple bags, just because it's fun. The 1-hour chart then, specifically looking at today's price action, we saw price rally up, then price came down into this fair value gap, trade up higher, then came back down again, reclaiming that fair value gap, then saw an expansion higher, taking out these relative equal highs, which were way too clean. Then trade up into this inversion fair value gap, which in essence is also a BPR for the same reasons I outlined on the 4-hour. But I outlined it there as inversion because I specifically use this range and like not this range. We then see how it trades up into the daily SEBI premium high. Notice how the bodies are respecting that exact level. The wicks go above it, yes, but that is fine. We look specifically at the bodies because they tell the story. So the body's respecting it, and then what follows suit is a decline lower back into that same fair value gap here, reclaiming it once again and showing again a rejection of it, at least on the near term. It is also cool to see how the wicks then do overshoot the daily premium array, but still respect that inversion fair value gap on the 1 hour. Look, it literally stops dead in its tracks there, and we can say the same thing about the body stopping at that daily premium array level. So these kind of signatures, even in like at the start of January, where it tends to be less clean and the precision elements tend to be a little bit less than usual, it's still very nice to see how it still is there at certain points in price action. But as you can already see, it was like a ranging day, especially like in the New York session. London had a very clean move, which we go into later in this review. Alright, 50-minute chart. So I want to talk about specifically this event horizon. But first of all, let's take a look at the overall structure of the day. It was a very large expansion relative to the ranges that we saw in London. We saw an immediate rally higher from the midnight open. It just had a very slight move below it, but it was like it's really minimal, and then price expanded higher, trade above this new week opening gap, came back down into this new week opening gap, and then continue its expansion higher. One thing here, it gapped lower, and I see it's not really outlined on this chart, but we gapped lower at Sunday. Then we moved up higher into it, filling the gap, came back down into the gap, and utilized this as a discount rate to send price higher. So that's what happened prior to all of this price action. Like I said, we then expand higher right from the midnight open, trade above a old new week opening gap from December 23rd, then came back down into it, utilizing it now as a discount array. So this always excuse me. Nice. So it's like basically the standard procedure of like when you expect higher prices and you have like a new week opening gap above market price relative to where you are now, you often see initial resistance at the new week opening gap, often like the discount low, and then price to trade back into, on the lower time frame, a discount array, and then you see often then the expansion higher to reach up into CE. Then you see like a similar scenario where it then or the initial finds resistance again at CE, retraces back down into a discount array on lower time frame, then send higher, or it drops down into CE and then again trades down into a discount array on a lower time frame and then expands higher and then comes back down into it and finds support again. So basically what I'm saying is that price often finds initial resistance at the new week opening gap and then eventually trades above the new week opening gap and then comes back down into the new week opening gap, utilizing it as a support level. So basically, premium array, initial resistance, trade above it, discount array, provide support, set price higher. That's basically what we saw here today too. So it's like really the signature what I'm looking for and what I'm expecting to see. Sometimes it just rams through it, but often this is what you see when you expect them really to fail. So now I have a look at the event horizon PD array and how I utilize it to derive at the expectation of higher prices, specifically in London. So let's first what even is a event horizon. So I see greater energy between like the idea of new week opening gaps and a concept of real concept in astrophysics. So the event horizon is basically the point of no return. Once something crosses the event horizon, the gravitational pull is so high that not even the speed of light can escape from it. So when something crosses the event horizon, it will be pulled into the core of the black hole, which is the singularity. So basically, once you cross the event horizon, you cannot escape the black hole, and you will be in there until who knows when. So in terms of trading, once something crosses the event horizon, it will get pulled into the new week opening gap that resides above it in this case. So how do we define the event horizon? We define the event horizon PD array as the midpoint between a new week opening gap and another new week opening gap. So in this case, I was bullish, I was expecting higher prices. Price trade above this new week opening gap, trade back down into it, and then expand higher again. I define this as then the low, or like 1. Then I looked at my chart with new week opening gaps, and the nearest new week opening gap, at least in a look back of 8 weeks, which I look at, is this new week opening gap from the 29th of December. So I define that as 0.0, and then I look at the midpoint, which is in between the midpoint of these new week opening gaps, and that is then how you derive the event horizon. So once something crosses the event horizon, then it has no choice but to get up into the higher new week opening gap, because the price of the new week opening gap really pulls price higher up into it, and that's basically what happened here. So it's really one of my it's really one of the PD arrays I'm really starting to dive into, because it's really a very powerful tool. Because really, once price crosses the event horizon, you already know that there's at least a very high probability that price will reach up into that higher new week opening gap, and you have like all of this range which you can either try to engage in and get in sync, or if you already were in a position back down here, you know that you can pretty much wait for price to trade up into it, and then manage your trade with the expectation that you perhaps leave a runner up into this level. And yeah, it's just a really cool concept, because it's really just I really like how ICT creates the analogy with the just with the real black hole and event horizon, because it really makes sense in terms of price action. Just cool how he just use those concepts into trading. It's really creative. But then price reached up into that new week opening gap, and then we had seen consolidation. I anticipated this in my pre-market analysis. I anticipate a consolidation in the pre-market. Why? Because we had a very large overnight range, right from midnight all the way up to the 7 a.m. We just saw a one-side expansion higher. So now back to the core concepts: market cycles, expansion, consolidation. So, and also just the logic from the smart money versus retail, the market efficiency paradigm is what it's called. If I was a retail trader, I like to always do a small role play um, situations. What is this? When I'm watching price action. Um, so I like to embody the retail perspective, and I think then, if I was a retail trader, um, what would I think when I see and open the charts at 7 a.m. for example? Well, I would see a very large expansion on London, throughout London, and all the way from midnight. So I would think, oh, this is really bullish. Let's go long. I want to get in sync with it. I don't want to miss this. So basically that. And if I then was the algorithm, or what would I then do to neutralize as many of those retail traders? I would just keep it in a tight range. I would keep it in the consolidation range so that both traders who try to get in sync with it, going long, would get stopped out, squeezed out inside of that consolidation. And I would also create a consolidation so that traders who try to pick it up, thinking, oh, it has been going higher, so it should go lower now, for example. It took out all highs, so, and it showed resistance, etc. I would also squeeze them out and just held it in the consolidation range so that both sides of the liquidity are basically cleared. Same thing we see here. Traders who went long, however, at London, they throw their stop up to protect their position. And where will they throw it down up to? Below old lows. So what does the market do? At 9:15, it dropped down, took out the old low, sells liquidity. Here also pre-market sell side, and neutralizes the vast majority of those long positions who were profitable. Might still be, but are at least squeezed out. So then the market expand higher from the 9:30 opening, just continue its move higher. Price could not reverse from this. Why? Consolidation, expansion lower, which is basically just a consolidation reversal. No, that's not possible. Price cannot reverse from a consolidation. So whenever we are in a consolidation in bullish order flow and price drops lower rapidly, you already know this is false. This is a fake move, because price cannot reverse from a consolidation. It can do a stop hunt, which is exactly what it did. AMD bearish, accumulation, manipulation, distribution higher. So we saw distribution higher than 9:30 and all the way up into like 11 a.m., reaching up into that daily SIBI premium high. We had a similar idea. I had a similar idea here of the event horizon, but trading remains a probability game. So you see, it was this idea of event horizon unfolds very, very often, but not always. And the reason for it not always unfolding is because there are other premium arrays of significance, specifically derived from a higher time frame, which can keep price from doing so. And that was in this case this daily CBM premium high and that 1 hour inversion for value gap, keeping price from just reaching up into that NWOG opening gap. I was really looking for it, good price to reach up into it, but no, it stopped dead and it tracks at the high of that 1 hour inversion, which was also cool to see. We had S&T at the highs, which caused a reversal, and we said see then the market trade lower. Price trading up into this relift rebalance. Sells delivery, buys delivery, sells delivery, balance price range, price reach up into it, and declines lower. And then we see this thing here, which was also cool to see. Price reached up into the midpoint, which is CE, of this inversed discount wick. So on the buy side of the curve, this was a discount wick that if price would trade into it before reaching its draw, we would anticipate price to go higher from there. But because we're now on the sell side of the curve, we anticipate discount arrays on the buy side of the curve to act as premium arrays on the sell side of the curve, and that's a whole mouthful, but yeah. So price reaches up into that, finds resistance, and drops lower back down into that new opening gap of the 29th, and then reaching back down into that 1 hour value gap again, reclaiming it once more, and back into the range, closing near equilibrium, defined by this low, leading range low because it took out a level of sell side, leading range high because it took a level of buy side. Equilibrium is around here, and that's where the market closes, which is exactly what we anticipate on days where we consider a consolidation to like a ranging day, consolidation day. To close near, that is equilibrium. This is the type of price action you will probably see a lot in at least the first weeks of January, of these type of ranging days, where the market just doesn't really move anywhere, at least in certain sessions. And that's what we saw here, that you had a large expansion in London, but New York was basically just range bound. It didn't really move anywhere at all. The preliminary race. So it was a continuation with the news basically. Alright, a 5-minute chart. You can see here indeed the event horizon idea that I had here, defining by this new week opening gap, and then the higher new week opening gap above market price. Once price crossed this, I was anticipating for price to reach up into the higher new week opening gap, and it came very close. So if I would have executed on it and everything went well, I would have at least be in a position to take partial off. I would not have perhaps at my terminus, but you don't need to be right to be profitable. You just need to be partially right, but not completely right. You don't have to be like 100% accurate in your targeting it is to make money partially. So you had an SMT at these highs, 3 drives pattern, which is running out buy side liquidity. 1 drive, 2nd drive, 3rd drive, and then even a 4th drive if you incorporate it on with the SMT, because he has made the 4th drive higher. Then price reverses straight up into this bearish order block, which is the change in state delivery, from bullish to now a bearish. Trades up into it, sells off. Notice how this consolidation occurs around that daily CB premium high. We trade up into this inversion fair value gap, sells off lower. Even more specifically defined on the 5-minute. I refined it a bit. You can see that price really reach up into that wick CE level, and then also converging with this fair value gap here. And this is already balanced, so you would, in essence, if you would short this, you could just place your stop here. If it was any other day, I would still place it here, because look at all the wicks we saw, really high resistance to get the running conditions. Look how much back and forth movement we had here with very long wicks, and that's exactly why I elected not to trade today, because of my rules of not trading before the 14th, 15th. But also, if it was any other day, I would still not have elected to trade this, because it's just very high resistance in nature. London was clean, but if I was watching the PM session, I would just pass on it, even though I might anticipate to decline lower. It's too tricky, at least to my appetite. With these long wicks, even if you are right in your direction, you can still be stopped out, and that's just high resistance liquidity run conditions, and which I like to avoid. I just want to solely focus on low resistance liquidity run conditions, where it's much easier than this. You can still trade, and it's very interesting to observe, but I like to just focus on the cleanest trades, and not force myself in conditions where I know that the probabilities are lower for me to actually be profitable. But it's a market maker sell model, sells out of the curve. Eventually price does accelerate lower into the new week opening gap. Then we have are reclaiming that 1 hour value gap, SMT at the lows, and then a final expansion higher back into the middle of the range. One more thing, the news at 9:45 was used here as an accelerator to reach up into this in the last hour of trading, with the last couple of minutes of trading. And then we close near the 1:30 opening, which is the opening price for the PM session, and that's really what you anticipate on like ranging days, for price to close near its opening prices, and that was the case today too. So finally, we arrived at the London trade review. This was a demo trade. Like I said, I'm not engaging yet in the market so early in January. But what I do is tape read and demo trade, because it's very valuable to gain experience in the marketplace and get like a better read on it and just improve your craft. And that's what I did here. I initially was actually wrong here. I was looking for perhaps a sell model back into the midnight opening price. So I entered here short and then pyramided my position larger at this order block. But it would not pan out. SMT at the lows, and then I like really identified this thing is going higher. My eyes were immediately on the buy side liquidity levels above. So I accumulated my position inside of the breaker, which are just some notes to myself that I put in my journal. But you can accumulate inside of the breaker's range, either using a PD ray that is formed inside of it, or just really inside of it itself. In this case, I was looking at this Foreman bands here, which was inside of the bullish breaker, and that's where I accumulated my long positions. Already having the backdrop of this Foreman bands supporting price higher, the new wick opening gap, the SMT at the lows. Also, I saved my stop loss here. When price rejected off the new wick opening gap and had a divergence at the lows, I just cut it off immediately. So then I bought more here at the breaker, anticipating really the breaker to form, so accumulating inside of it. Then price did trade back down into the bullish breaker, and this changed in state delivery order block, found support, and just rapidly reprices higher. Look how clean it is compared to what we saw on the 5-minute chart in New York. There was a lot of back and forth movement, and this was just a one-side delivery. Most Dow close candles make sense here, almost all of them. In terms of that they just return down into a discount array. For example here, price retraces back down to this value gap, trades higher, trades down this order block, trades higher, to this value gap, trades higher, etc. So I took some partials here. As you can see, it was a pretty high R trade, and generally like take at least something off at like 3R. So I took something off here, which in hindsight was not the most logical level in terms of reasons to take something off, but I just wanted to take something off here at 3R out 5 contracts. So I took one off here, then I was running down equity because I just want to take partials underway, and there were not really any logical levels to do so. And that was the only thing. It took out lots of levels of buy side and then retraced back into that range, so it was not like a one-side delivery retracement. It really was just hovering higher, which you tend to see when you get close to the end of London. So I took a partial every time here, price create a short-term high and then took it out, running down equity like I said. So I took 3 contracts off in total here, then price retraced back down into a order block, and I had the divergence to the lows with yes, and then price took off, and that's when I knew, yeah, I'm on side, this thing is going for the London buy side, and that's what it eventually would do, because it was like an SMT at a level where I anticipate price to go higher from. And yeah, when it then really started to take off, had to change in state delivery here, then I knew I was likely on side, and I eventually got my limit order filled just above the London buy side liquidity for this 9R trade. Yeah, it was, and this is an A+ trade in my book. Literally, yeah, buying inside of the breaker as the stage 1 accumulation. This is smart money reversal. It's a low risk buy. This would be then a stage 1 accumulation, where I bought inside of it. We're just anticipating stage 1 to take place, and then we have a second stage. Yeah, here price could have dipped down into this, but it didn't. It just really stayed inside this inversion, and then just expanded higher. and that we just took off. So that is going to be it.